The fourth risk I'd like to address today is the volatility risk. You find that the stock market experiences very sharp, unpredictable price swings, and there's a lot of emotional buying of shares. I'll give a good example. When Safaricom PLC pays a high dividend, you find that there's so much demand for Safaricom. What happens is when the market recovers, the share prices will go down. So you need to avoid emotional buying of shares. You need to have a strategy and stick to your plan. The advice I can give you against volatility, kindly avoid selling shares because you can see the share price is going down. Relax and hold on to your shares. If you really need money, just ensure you give a minimum price that you're willing to sell your shares. The other advice I can give you to protect your funds against volatility is to ensure that you invest in the blue chip companies. Those companies have very stable earnings and not likely to experience a decline in their share value. The fifth risk I would like to address is the inflation or interest rate risks. You find that when the Central Bank of Kenya increases the base rate, investors tend to shy away from the stock market. The treasury bills, the treasury bonds, and the money market funds tend to be more attractive to investors. How do you protect your hard-earned money from stagnating stocks? Ensure that you diversify your investment, like we said, in bonds, treasury bills, money market, or even in gold. The other tip is to invest in companies that can pass the interest rate costs or the inflation cost to consumers. For example, the EABL, the Coca-Cola, food companies. They will always be able to pass the increased interest rates to the consumers. The third tip is to ensure that you reassess your investment when the interest rates goes up. The fourth tip is that you keep your portfolio in a foreign-dominated asset to hedge against inflation. The sixth risk I would like to address is a political and economic risk. A new government can introduce a new philosophy that does not favor investors, therefore causes investors' confidence to go down, and therefore your share value goes down or the shares of that company stagnates. Economic risk is when the government introduces many policies that affect investors. For example, new taxes, things like capital gains, that can easily spook investors, causing the share or the stock market to stagnate. To protect your money against political and economic risks, invest in the regional and international